Welcome back to day 12. This is now part 2 in risk management, and we are learning the hidden secrets on becoming a long-term profitable trader. Now, today's game plan, we will be going over capital protection, followed by numbers don't lie, then on to position sizing, and today we're going to finish off with trading tools. So we're just following up from what we learned in day 12 part 1. Now, to review very briefly what you learned in the previous module, we learned that there are 3 general risk profiles, which are conservative, moderate, and aggressive. So a conservative trader, they risk 1 to 2% per trade. Moderate is typically around 5%, and aggressive traders 10% or more. Now, we aim to risk 1 to 2% per trade based on our overall account balance. So if you have $10,000 in your trading account, you're looking to risk $100 to $200 per trade. Oversizing positions, we also learned about the rookie mistake. This is the number one death of all traders. So mainly new traders, but many experienced ones as well. If you're oversizing positions, not only are you going to lose your capital, you're going to be less confident when you open up your new account. You're going to say things to yourself like, well, it doesn't work. You may start blaming other things apart from yourself. When many people oversize positions and they blow their account, they start saying it was the broker's fault, or my trades are being manipulated, and they make tons of different excuses, but it really just comes down to their lack of following their trading plan. And we also can't expect to force 5 years of really hard work into just 3 months. You can't expect to turn 10,000 into $500,000 in 3 months. It takes time. It takes time to get the results that you want. So just keep that in mind. Now, in our first topic today, it will be capital protection. This is all about stop loss and take profit. I will be running through the stop loss and take profit rules for all of our harmonic patterns that we have learned so far. But I'm just going to get the basics down first. As I mentioned in the previous module, and I've probably mentioned it in other modules that we've covered in the 14-day course, you need to accept that you will lose in trading. It's just a part of doing business. Now, this means it is your sole responsibility to correctly manage your risk to prevent large drawdowns. So we covered drawdowns in our previous module and what that means, which is obviously consecutive losing positions. And we do this by using a stop loss and take profit when trading. We always use a stop loss level, and we always use a take profit level when trading. If they are not in place, you're not taking the trade. Now, an example of a stop loss, let's say for instance you are looking at this market situation. The market has been moving up for some time now, and you place a buying position. You expect the market to keep on increasing. And what happens is you go into profit. You can see I've highlighted this in green. You can see that the market continues to move up, followed by a retracement, and actually the move pulls back to break even, what we call break even, pretty much where you entered the trade. You can see that price moved up, you were in a short-term profit. Now this is where your stop loss comes into play. Before we placed this trade, we would have placed something called a stop loss. Now we can see the trade moves into a slight loss. Let's say, for instance, we had a stop loss at this level here. This stops losses occurring after this point. So we can identify certain price levels or certain points on the chart, and where we dictate where our losing position will stop. So let's say it's Great Britain pound Japanese yen. You entered at 150. Your stop loss was at 160. As soon as it hit 160, you would be out of the trade. It's a losing trade, and you move on to the next one. And this is what it helps prevent. We can see that price actually dropped further before actually picking back up. And if you don't have a stop loss in place, what can happen, you could actually get caught up in a a change of trend long term, and you could be holding a losing position that could actually be, you may have only placed 1 to 2% of your account. You could have placed a really small lot size, but the entire trend could change. And I see this, a lot of traders do this, and it's just not a profitable way to trade. They'll hold a position no matter what and just wait for it to return. They'll wait for it to return to where they entered, and then they'll close the position. Rather than having a stop loss in place from the beginning, they won't trade with a stop loss. They'll just buy or sell, and no matter what happens, they will hold it until it makes a profit, or they will hold it until price returns to their break-even level. But you could end up losing 30% of your account, even if you only risk 1 to 2%, if you didn't have a stop loss in place. You could get caught up in a change of trend long term, and you could be holding a losing position for a very, very long time. So a stop loss level, it keeps us safe. It's all about capital protection, and that is what this topic's all about. Now, a take profit level, on the other hand, let's say, for instance, the market has been uptrending for some time. You spot an M or W type structure. In this situation, it would be a W type structure. You're looking at a reversal. So you're looking at a, let's say, for instance, a bearish back, and you decide to sell. And the trade goes instantly into profit. Now, where do you dictate where you get out of the trade? So previously we have covered the stop loss, where you dictate where this is where I'm getting out of the trade as a losing position. I don't want to incur any losses after this point. And this is where you decide the trade is closed at a loss. Where do you decide that the trade is closed in profit? And this is why we use a take profit level, because of course what we don't want is the market to move against us and we wipe all of those profits we've worked so hard to gain. And we can see here, price dropped just below our take profit level, where we closed the trade in profit, and it actually started to move back against us. So we would have therefore made less profit. Now, these two levels, they are very simple to apply in trading, and I personally will never, ever, ever enter a trade unless I have identified where I'm getting out before I get in. So I always do that first. I identify where am I getting out before I actually get in the trade. So I always have a stop loss in place. I always have a take profit level in place. Now, what I'm going to do is do a stop loss and take profit market walkthrough. Now, what I mean by this is I'll show you exactly where to place your stop loss and take profit for the bat pattern, the Gartley pattern, the butterfly pattern, and also the crab. So once again, we're back on the charts. I know the previous module we had a bit of time off. We're back on the charts this time. I'm going to walk you through every pattern individually and show you how to manage your positions, how to get in, how to get out, and show you the ideal levels to stop those large losses occurring. So let's head on to TradingView and we'll break down stop loss and take profit. The first chart we're looking at today is Great Britain Pound Japanese Yen on the 4-hour chart. We're looking at a valid bullish bat formation. This is the one we covered in day 9 in the 14-day course. And I'll start off by plotting the stop loss measurement. We're going from X to A. And I'll add in the 0.886. This defines the XA retracement for the potential reversal zone. We're looking for price to confirm that measurement before we have a reversal and price moves in the opposite direction. I'll add in 1, which is 100%, and this of course defines the X point, and we always want to go beyond X in a bat pattern for our stop loss. X is the absolute minimum. We always want to go beyond X, and I typically employ a 1.13 measurement. So we're going from X to A, we're adding in a 1.13, and this is really where you want your stop loss to be. It gives the trade enough room to move, and we're still utilizing a 1 to 2 risk to reward in this trading situation as well. And I'll give you an example of this. If I just plot our take profit levels, we're going from A to D, which is highest to lowest. And we're utilizing a 0.382 as our first take profit level and a 0.618. And the 0.382 is more of a management level. once price achieves what we call our first take profit level, this is when we would look to move our stop loss to break even. And this is what we call bulletproofing the trade, because if price had to reverse and hit our stop loss, we wouldn't lose any of our capital. And this is why we call it capital protection. And we want to limit our losses and maximize our gains, our profits. Our second take profit level, this is when we would be out of the trade, and we can see this was achieved with this extremely aggressive move to the upside. Once price achieves this 618 retracement level of A to D, we're going from the highest to lowest, A to D, this is when we would be out of the trade. Now, one thing to note about the take profit levels when you're measuring them, if price exceeds D, which we can see here, and if I just highlight this with the trendline tool, this is the lowest point before we got any type of reversal. Now, it's important to note that if price exceeds D, the measured point, and price continues to move lower, we really want to measure our take profit from the new D point, what we would call the new D point, which is below the ideal measured level, because we're measuring this entire price segment here. We're measuring from A all the way down to D. So we will always want to go from the highest to lowest point before we get some type of reversal. We can see that doesn't change the levels too much. So in this trading situation, it wouldn't be as much of a big deal as it would in other trading situations. We're really looking to go from the highest, from A, down to the lowest point to D. And like I mentioned, if price exceeds this D point at the measured level, we really want to go from the lowest point with our take profit levels. And this is why it's important to get the best possible entry for your trading opportunities. Now, as I mentioned, this first take profit level at the 0.382 is what we call the management level. And at this level, you're looking to move your stop loss into profit. You may also reduce your trading position by 50%. So if you're trading with one lot and price achieves your 0.32 take profit level, you may reduce your position by 50%. You therefore have half a lot left in the market. You've taken 50% of your original position out of the market, so you've taken some profit. And you would also move your stop loss at the 1.13 to break even. So break even basically means if you entered where this black line is, you would move your stop loss just above. You'd move it into sort of this area here. And basically what this does is, if price achieved this level here, but instead of moving to the upside, it started moving back down towards your D point and then hit this level, it means you would be taken out of the trade with no losing capital. You would obviously move on to the next trading opportunity, or you would look for another entry on this position. But once price moves back down to the D point, if that's where your stop loss is, and break even, which means you wouldn't be losing any capital, you would automatically be closed out of the trade. Because what we don't want is price achieving this level, which is quite a significant move, and then it continues to move all the way down to this 1.13. And what could have been a profitable trade actually turns into a losing position. So if I just highlight everything I've said with the long position tool, and I forgot where it is now. It's this section here. So we're just below where the XABCD pattern tool is. We're looking at the long position tool. This is the easiest way to plot your stop loss and take profit levels. And let's assume that we entered exactly at the D point. Although we're measuring our take profit levels from below the D point, let's just assume we entered at the D point. Our final take profit level is at the 618. This is where we want to take profit and close our position completely. And I would always utilize a 1.13 in the back pattern when we're looking at our stop loss. There are many other trading situations where you can have your stop loss in between the 1.0 measurement and the 1.13. As long as it's beyond X, this will give you a more favorable risk to reward. And at many times it can be 1 to 3. Risk 1%, you'll gain 3% in one trading position. But it's always wise in most trading situations to go just beyond this 1.13, utilize a 1 to 2 risk to reward, meaning if you risk 1%, you're making 2% on the entire trade. And this entirely depends on how you manage your position. Let's say, for instance, you close 50% of your position at the 0.382 and leave half of your position in the market. Then this will, of course, change your overall risk to reward. So sometimes it is wise to use a stop loss in between 1 and 1.13. This is subjective. It entirely depends on the market condition and how it's moving in previous areas of support and resistance. But just as a general rule, we want to utilize this 1.13 measurement in the bat. The next opportunity we're looking at is Canadian dollar Swiss franc on the 1 hour chart. We've got a bearish back formation. The exact same one we looked at in day 9 as well. I'm trying to keep this as familiar as possible rather than introducing completely new charts and patterns. You've seen this pattern before, this exact same setup. Just plotting the stop loss measurement, we're going from X to A. And I would recommend putting in the 886 just so you can see exactly where that XA measurement completes for the D point. Add in the 1.0 measurement, the 100% measurement at X. And then we're just going beyond that with the 1.13. And this is almost like we're layering the ratios. So we're going from 886 to the next ratio, which is 1. The next ratio after 1 would be 1.13. So we're just layering these ratios, and this is how we get our stop loss measurement. And it's almost the same in every single situation. We just use different ratios. For the Gartley, for example, we're going just beyond X. The butterfly, we use a 1.414. For the bat pattern, of course, we're using a 1.13. Now, when we're plotting our take profit levels, we're going from A to D. You can see the price just went beyond D before we got that reversal there. We're not measuring from this point here. We're really wanting to go with this area at D. This is where we got the significant reversal at first, and this probably did achieve the 0.382 measurement. More than likely didn't achieve the 618. So just pull this across so you guys can see exactly what we're looking at. So we're measuring from the highest point in this area, just exceeded D ever so slightly, and that's really the measurement I'm looking at. We're wanting to measure from A to D, but if we do see that price exceeds D before we get some type of reversal, we really want to go with the highest area above D. So this is the area I'm looking at. You can see price achieved the 0.382. It looked like it almost achieved a 50% measurement as well, just above the 0.5. And this is where we would have moved our stop loss into profit or break even. So if we had our stop loss at the 1.13 up here, we would then adjust that and change the price to this area here. And this is where our stop loss would have been, around about this area, just so we're in break even and we're bulletproofing the trade, preventing any losses. We don't want a profitable position to turn into a losing position. And let's assume that you didn't take any of your position out of the market. You kept 100% of your position in the market and you moved your stop loss into profit. So what would have been your stop loss in red here? This is where you would take a losing position. It then turns into a very, very, very small profit. So it just secures your position. And what we can see happened here was price reversed from almost this 50% measurement, and then you got taken out of the trade. And when that happens, this actually provides another opportunity. This provides another trading opportunity where we can re-enter the move upon the secondary test. And we can see upon this secondary test, this is when we got the full extent of the reversal. It consolidated in this area for a while, moved sideways, and then we got the move down to the 618. So this is just something to be aware of, and it's entirely your choice on how you manage your own positions. Whether you take half of your position out of the market at the 0.382. There's many traders that keep their full position in the market until the 618 has been achieved. But I would always recommend utilizing that stop loss rule. Whenever you achieve that first target, move your stop loss into profit. I would recommend doing that. And if you get taken out of the position, you can always look to re-enter the trade based upon price action at the secondary test of the potential reversal zone. And I'll just highlight everything we've been talking about with the short position tool. So the long position tool, of course, you use this when you're buying. The short position tool when you're selling. And let's assume we entered exactly on the D point. We're not looking at the secondary test at all. We're just looking at the initial reversal, this area here. This would have provided around about a 1 to 2 risk to reward again. So we're looking at a 1 to 2 risk to reward. Depending on the trading situation, I recommend you could utilize between a 1 and 1.13. This would give almost a 1 to 3 risk to reward. But you're always wanting to go beyond X. This is the absolute minimum. It's very rarely you'll ever see me going just beyond X with my stop loss. Most of the time it's in between a 1 and 1.13. The ideal stop loss, we're looking at a 1.13, but this all comes with experience. You will get to grips with your own trading once you start trading on a demo or live account, and you'll begin to understand the way that price moves. You can then start moving your stop loss in between the 1 and 1.13 depending on the trading situation. But just as a general rule, we're looking at the 1.13 in the back pattern, and this still provides the minimum 1 to 2 risk to reward. So we risk 1%, we make 2% on this one position. The next trading opportunity we're looking at is silver on the 4-hour chart. We've got a bullish Gartley. You can see we've got the 618 B point. Just below the 618, we've got a 622, a 0.786 X to A. And we don't need to measure from X to A with the stop loss, but I'm just going to do it to highlight what we're actually looking at here. I'll add in the 786 and I'll add in the 1.0 ratio, the 100% measurement. So anything beyond the 100% is a projection. We're obviously looking at the 786 retracement that defines the D point. And with the stop loss in the Gartley, of course, you can see this area between D and X is significantly larger than it is with the BAT. And this is why we don't go too far beyond X with the stop loss. We're looking to go just beyond X with our stop loss and keep the trade a 1 to 2 risk to reward. For our take profit levels, we're going from A to D. The typical rule is A to D for our take profit levels. We're using the 382 and the 618. But as I've mentioned multiple times before, if we don't get that reversal off the D point and price moves lower, it's always wise to bring this down to the new D point. Of course, this would be this area here. It's always wise to bring price down and measure it from the lowest point, because of course we're measuring this entire price segment from A to D. So you always want to be exact and measure from the highest and lowest point. And we can see that price achieved the 0.382 within a short space of time. This is when we would move our stop loss into profit. This would of course be green. We're not losing anything at this moment in time. Assuming we enter at the D point, that's our entry point. We take our stop loss from below X, we bring it up to break even above D. This is entirely dependent on your entry point. If you entered at the low here, at the lowest point, then you'd be moving your stop loss just above where you entered. That's really what we're looking for here. You just want to secure your position so you can't lose any capital. We can see we didn't even get a reversal of that 382, which can happen in many trading situations. You'll see that price will test the 382. It may reverse. It could even test D again, which can happen. This is why we have the secondary test, and we can get back into the move. It's still a valid trading opportunity. But in this situation, we can see an extremely bullish move, an impulsive move from D to our final take profit level at the 618. And this is on the 4-hour chart, and this would have been closed within less than 1 month. We're looking at 27 days here once price confirmed that 618 measurement, and that's where we would have been out of the trade completely. If I just grab the long position tool, and this is a very handy tool that TradingView provides if you use the long and short position tool. Just below the XABCD pattern tool, I use this quite a lot. Of course, I've explained the long position for buying, short position for selling. And it's an easy way to get an idea of your risk to reward for the position you're about to take. And we're always looking at that minimum 1 to 2. So we're going beyond X. We have the 1 to 2 risk to reward. It tells us our risk to reward ratio right here. Of course, we're looking at a minimum 1 to 2 in all positions. We really want to stick to that rule. I'm quite strict about the risk management rule of 1 to 2. Meaning we risk 1% on this position, we're walking away with 2% after the trade closes. And this would have been around about this area here. We're now looking at Euro Australian dollar on the daily chart. We're looking at another Gartley. This is a bearish Gartley. I'm just trying to provide as much variation as possible here. I want to show you the stop loss and take profit measurements for all patterns, whether it's bullish or bearish. I know it's going to be the same. For example, if we've got a bullish and bearish Gartley, it's going to be the exact same. Of course, the situation is just flipped. You're selling in this situation, not buying. We're going from X to A with our fib retracement tool. We're going to add in the 786. This highlights the completion of the pattern, the XA retracement and the potential reversal zone. And we're going to add in 1. And we're always looking to go beyond X. 100% of XA. I always add in 1 so you can see exactly where you need your stop loss to be. Beyond this measured level here, 100%. In this trading situation, we wouldn't have entered at the D point just because this additional measurement that we've not defined yet actually completes around about this area here. So our entry point would have been around about this area. And this is more advanced harmonic trading. As I mentioned in day 9, 10 and also 11. What we're really looking at just now is just these ratio measurements. We're getting into the habit of spotting these M&W structures in the market, and we're looking for precise ratio measurements. We're looking for these ratio measurements within a close proximity. That's a word I've used at least 20 times now over the last few days. But that's really what we're looking for. And the entry point on this position would have been at this area here. This is the last ratio we're looking to confirm based on an additional measurement that needs to be confirmed, especially in the Gartley. It's almost essential in the Gartley. So this would have been our entry point. Our stop loss, we're using that minimum 100% of XA, so we're going beyond X. And I'll not confuse you too much. We'll just remove this. And we'll keep this level here. This is where we would have entered the trade based on this additional measurement that's yet to be defined. But don't worry, that will make sense in later modules. Not in the 14-day course, but in the Harmonic Mastery course. That will all make perfect sense. We're just piecing the puzzle together at the moment. I want you guys to be familiar with your M&W formations first. That is the most important part. We're going from A to D. But of course, our entry point, this is where it completes. This is actually where it completes. So we're just going to measure from here for the purpose of this pattern. That's where the pattern completes. Of course, that would be our D point. We're going just beyond that. That would be our 0.382 and our 618 we're looking for. And we can see price is on its way just now to this 382 measurement. It looks like we've got a support trend line that's just broken, which it looks really, really good. So we're looking for price to continue to the downside and achieve this 38.2% measurement as our first take profit level. And like I said, the stop loss, we're going beyond X. And in this trading situation, just because it is unique and we have a higher completion point, and I'm trying to keep this as simple as possible without confusing you guys, because I know you're new to harmonics, many of you. Some of you may be slightly more experienced, but I'm trying to keep this as simple as possible. We're going with that 618. We're always looking at the 618 for our final take profit. And because we have a higher entry point based on the additional measurement, remember this is yet to be defined. We're looking to go beyond X. And because we have that higher completion point, we can actually look at a slightly larger stop loss at 1.13. But just stripping it down to basics, let's assume that all of the ratios confirm at D. And let's say we don't have an additional measurement that confirms up here. We're looking at the D point. Let's just assume that everything completes at D. And we're not looking at this 1.13 for the stop loss. This will all be defined at a later date. And when we go into more advanced harmonic trading. Right now we're just laying down the principles, the foundation for successful harmonic trading. If we enter upon D, all of the ratios in the potential reversal zone are confirmed at D. And let's just assume that's what we're looking at. We're measuring from the highest point. We can see that we got that instant reversal. That's really what we're looking at. And we take the short position tool. We're plotting it from the entry point at D. And our stop loss, we're going just beyond X. So if we enter at D in the Gartley formation and we don't have this additional measurement beyond it, we're looking to enter just beyond X. And this will all make perfect sense at a later date. But we can see here, we're always looking at that minimum 1 to 2. So even if you entered at the D point and you weren't aware of this additional measurement, which you would be in the future, you still would be in a profitable position at the moment. And we're looking to confirm that 0.382 measurement. That's the minimum. We're looking for our first target here and our second take profit target where we would close the trade and a profit, of course. We're looking at the 618. Now we're just going to take a very short break before we head on to the next trading opportunities, which is going to be the bullish and bearish butterfly and of course the bullish and bearish crab. The next trading opportunity we're looking at is New Zealand dollar Swiss franc on the 30-minute chart. We're looking at a bullish butterfly formation. And we're just doing the exact same as we did with the bat and the Gartley. We're going from X to A. We want to plot those measured levels. So we used 1 in the Gartley and in the bat. Not essential when we're looking at the butterfly. We're looking at the 1.272 and we're just layering these ratios. So we're going beyond that. The next measurement is 1.414. And that defines the minimum level for the stop loss. And this is the same for the bearish butterfly. We want to go with the 1.414 as the minimum stop loss measurement. Depending on the trading situation, we can go beyond that to give the trade more room to move. The take profit, we're looking at an A to D. And remember, we're always looking at price. If it moves beyond D, we're looking at the lowest point. Because we're measuring this full price segment. We're measuring from the high to the low. And we're looking at 0.382 and 0.618. And if I just highlight this with the long position tool, this looks like a 1 to 4 risk to reward, possibly a 1 to 5 risk to reward trade. Meaning if you risk 1%, you're making 4 or 5% on just one position, which is absolutely outstanding. And like I said, this is the minimum stop loss we're looking at. This gives us a risk to reward of 1 to 5 or 1 to 5.4, meaning risking 1%, you'd make 5.4%. This is based on the full position. If you reduced your position by 50% at the 382, your first take profit level, then of course this risk to reward would change. I would be more than happy just going beyond the 1.414 at 1 to 4 risk to reward. This gives the trade enough room to move to get that reversal, confirm it, and then of course move in the opposite direction. So just be aware of that. The 1.414 is the minimum level we're looking at. We're looking to go just beyond that. And like I said, I'd be more than happy with a 1 to 4 risk to reward trade. The next opportunity we're looking at is Euro Swiss franc on the 1 hour chart. We've got a bearish butterfly. And I'm just going to keep this as simple as possible. I think you guys get the gist by now. We're just going from X to A. We're plotting in our measurements beyond the completion of the pattern. So we're looking at a 1.414 in a butterfly. That sets up the minimum stop loss measurement. And I'll just pull this across so you guys can see what we're talking about here. The take profit, we're going from A to D. And remember, if price is above D, we're looking to go with the highest point. And as I've mentioned before, A to D is an oversimplification. If the pattern hasn't formed yet, then of course you're going from A to D. If price exceeds the D point, you're measuring from the new D point. And this sets up the take profit levels of 0.382 and 0.618. If If I just pull this across so you guys can see what's going on, we got almost an instant reversal off of the D point. You can see how quickly price reversed and started moving to the downside, and then we got an extremely aggressive move which achieved our 38.2% measurement, or 0.382 take profit level. And this is when you would have moved your stop loss into profit. And we do this with all positions. This isn't specific to just one harmonic pattern. The take profit rules are fundamental. We use them pretty much in all harmonic patterns. That's 382 and 618. You'll find that most harmonic patterns do have these two measurements, the 618 being the final measurement in the pattern. And we can see how precise that measurement is. Once we get the reversal of the D point, we achieve this 382. Price almost confirms the 618. We can see almost confirms it here as well. Pulls back to the 382, moves sideways, and then we confirm the 618. That's when we're out of the trade in profit. And price actually reversed off of the 618 and returned back to D. So you can see how precise these take profit measurements are. And this is why we utilize this in almost all trading situations. There's, depending on the market condition and how it's moving, or the market structure, we may extend our take profit levels to capture profits possibly at A. But this is a unique situation, and in almost all trading situations, we're looking for the 382 and the 618 take profit. And I'd stick to those rules at least until you're far more experienced in your own ability in harmonic trading. We're now looking at Great Britain Pound US Dollar on the 30-minute chart, and we're looking at our last pattern for today. We're looking at the crab pattern. We've got two examples. This is of course a bullish crab, going from X to A again to get our stop loss. We're looking at a 2.0 ratio beyond the 1.618. That defines our measurement for the stop loss. Our take profit levels, we're going from A to D. And this provides a 0.382 and a 618. And as I mentioned, we're going just beyond that. You can see this is the lowest point in this area. And if I just grab the long position tool, plot this at the D point, assuming this is where we entered the trade, once price confirmed all of the ratios in the zone. Based on the 2.0 ratio, we're still looking at a 1 to 2.5 risk to reward. So if we're risking 1%, we're making 2.5% on this one position. And the 2.0, this gives the trade enough room to move. And because if we see extreme price action in this area here, price might continue downtrending towards the 2.0 ratio. And sometimes in many trading situations, we don't get the reversal until we have an extremely extended D leg around about a 1.902. Just above the 2.0 measurement. So it's around about this area here. And that's quite a unique trading situation. But in most cases, we're looking to enter the trade in this situation here. And we're looking to utilize a 2.0 stop loss. And we can see that price almost confirmed the 618. Reversed. Consolidated for quite a while. It was moving sideways. And then finally confirmed the take profit level. And this is based on the 30-minute chart. If I just grab my date and price range tool going from the D point, would have been closed in around about 12 days, just less than 12 days, 11 days and 22 hours. Significantly longer than our previous examples when we're looking at the butterfly pattern, but this can happen. And our final opportunity for today, we're looking at US dollar, Japanese yen on the 1 hour chart. Got a bearish crab. This is our last pattern we're looking at today. We can see how far price exceeded that D point. That's exactly what I was talking about before. And this can happen in crab patterns or in all patterns. But can be seen in crab patterns, of course, we've got an extremely extended D leg. So this can happen if the trend continues higher before we get that reversal. So we're looking at the 2.0 for our stop loss. We're going from X to A. We can see how close price came to that 2.0 measurement. That's why I was talking about this 1.902 sometimes price will confirm this area just below 2, and then we get the reversal to the downside. And in this trading situation, I really would go from the highest point. That's where I would be drawing my 382 and my 618. Didn't really get a reversal in this area to the downside. I would really be going from the highest point. So we're really looking at this area here. Like I said, the A to D is an oversimplification. It still achieved those areas, but we're really looking to go with the highest point. So if we're going beyond D, this is the area we're going with. We're measuring the full price segment. And we can see price reverse just below this 2.0 ratio, and then we can turn to 0.382, which is our first take profit level. This is when you manage the trade, so you're moving your stop loss into profit, into break even, to secure the position, to bulletproof the trade. You can also reduce your position by a certain amount. It's typically 50%. If you're trading one lot, then you would reduce your position by half a lot. Or if it's 100,000 units, you'd reduce your position by 50,000 units. And then your take profit level, your final take profit level at the 618, we can see how quickly that was confirmed once the move was sparked in this area here. You can see we broke below like a minor support, and then we had an extremely aggressive move to the downside, and we almost instantly achieved that 618, and that's what would have closed the trade. That about rounds it up for our stop loss rules for these patterns. Let's head back to the slides and we'll finish off the rest of today's module. Moving on to our next topic for today, numbers don't lie. Now, it's all fine and well when I tell you to risk 1 to 2% per trade, but you're not going to believe how effective our risk management strategy is until you see the numbers broken down. So this is why I've created a risk management simulation, trade by trade, using the following: 1% risk per trade, 1 to 2 risk to reward, so we can keep the results comparable. Now, you can do this in your own time. You could make it 2% risk per trade if this is what you plan to do. I wouldn't recommend risking 2% every single trade. 1 to 2%, remember, 1 to 2%. Your risk to reward, now sometimes this may be 1 to 2.5, 1 to 4, like we've seen with the butterfly pattern. It could be 1 to 2.6, like we've seen with the crab. But for now, I've kept it 1 to 2. Now, the profitability rate, this all depends on your personal trading ability. Do you have a profitability rate of 60%? This means that out of 10 trades, you make 6 successful positions and you have 4 losing positions. Or 100 trades, you have 60 winning trades and 40 losing trades. Or do you have a profitability rate of 70%? You have a higher profitability rate. For every 100 trades you make, you have 70 successful positions and you have 30 losing positions. Well, this is why I want to break down the numbers. On the left-hand side, we have a 40% profitability rate, a 1% risk per trade, and a 1 to 2 risk to reward. Now, remember, these numbers will change. Let's say you only traded a risk to reward of 1 to 3. Again, the numbers will change. If you risk 2% per trade, the numbers will change. So these are specific to the numbers and the risk management strategy we are using. We have 1% risk per trade, we have 1 to 2 risk to reward, and a 40% profitability rate, which means you're actually losing more than you're winning. You're losing, for every 10 trades, you're losing 6 and winning 4, which is less than 50%. Now, to most people, if I told you, if you come in and you get half your trade right and half your trade wrong, are you going to make profit? And to most people, they'll just think instantly, no. You won't make any money, but you won't lose money either, which is wrong. If I say to people, if I lose 6 trades and I only get 4 right a month, so I lose more than I win, will I be profitable at the end of the month? They'll tell you, hell no, you'll not be profitable, you'll lose money. And this is where people don't look any further. They don't look at the details, they don't break down the numbers, whereas I do. I care about risk, I care about other people's capital, and I'm always looking to advance my risk management strategy as much as I can. Now we can see here, we're starting off with an account value of 10,000, and we're risking 1%. Now our first trade, and I've done this on purpose, we have our first trade, which is minus $100. Then we're risking 1% of $9,900, which is minus $99. We have 6 losing positions, so 6 consecutive losing positions, and this would be your drawdown. You have a period of losses, 6 losses in a row, and then this is when the profit starts. You're risking 1% of $9,414 at trade number 7. Remember, you're risking 1%, but you're making double, which means you made $188.29. Now you can see by the end of, let's say this is a trading month, for example, you have a bad month in trading, you lose 6 trades, you only get 4 right, you have 4 profitable positions. By the end of this trading month, just by using 1% risk per trade, 1 to 2 risk to reward, and you're right less times than, sorry, you lose more times than you win. So you're really right. You're only right 40% of the time. You would still have a growth rate of 1.9% per month. 1.9%. Now on the flip side, we have on the right hand side here, we have the same risk per trade, the same risk to reward, and a 60% profitability rate, which means instead of losing 6 trades a month, you're now winning 6 trades a month and you lose 4 per month. So I have put the 6 winning trades at the start here, and then we have the 4 losing trades at the end. At the end of that month, or after 10 trading positions, you will have grown your account by 8.1%, and that is risking 1% per trade, 1 to 2 risk to reward, and being right a little over half of the time. So what do we know? If we stick to our risk management plan, we can actually be right less times than 50% and still turn over a profit month to month. We only need to be right 40% of the time. If we stick to the rules, we follow the trading plan, we only need to be correct 40% of the time, and we can still break even. We can still make a small profit. We can still make almost 2% a month. Now, if we're right more than half of the time, we're right 60% of the time, and this is based on 10 trades, remember, not 2, not 5, not 7, it's 10 trades a month, or per week, how often you trade. But let's say 10 trades in a month, which is realistic, and you have a 60% profitability rate, then you're looking at a growth rate month to month of 8% or 8.1%. And this is what I want you to do today. I want you to go away, break down the numbers, do it trade by trade. You can see on these charts here, I've done this trade by trade. You first start off with 10,000, you make $200, you're now trading with 10,200. Or on the other side, you're trading with 10,000, you lose $100, you're now trading with 9,900, which is your overall account value. Remember, when we're risking 1 to 2%, it's based on your overall account value. So what I want you to do is go away today. You can start crunching down the numbers on different aspects of trading. Let's say you're risking 2% per trade. This means the figures that you can see at the bottom here would now be double. The growth rate on the left would be 4%, just below 4%, 3.8. And the growth rate on the right would be 16.2% per month based on 10 trades. Let's say you have a higher risk to reward, but you're still trading 1% risk per trade. You strictly only take trades that have 1 to 3 risk to reward. Or let's say you have a higher profitability rate. Let's say you're correct 70% of the time. Then again, this increases the amount of profit you'll make month to month. And this is where many people lack vision. They say they want to make $1 million, but if you ask them how much they had to make a week or month, they wouldn't be able to tell you. They just know they want to make $1 million, but they've never actually written down the goals and calculated what it's going to take. They'll tell you they're going to make $100,000 in trading this year. They've maybe got 5,000 right now, but they've not done the numbers in order to calculate their success. They don't know what it's going to take every month or every quarter in order to reach that goal. And this is where I want to change things for you guys. I want you guys to go off and do this and get into a habit of doing this quarterly or even every 6 months. When your trading changes, you become more profitable. I want you to sit down, pen and paper, and calculate this. So you can see your vision actually mapped out. You can see what your potential growth could be month to month. Now on to our next topic, position sizing, which is extremely important. Of course, you want to be able to calculate how to risk 1 to 2% per trade. Now, calculating your position size, it can be done manually. Now, as I've mentioned multiple times throughout this course, if you do everything manually, it's just going to take up a lot of time. And I understand many of you, or most of you, have day jobs, and you don't have the time to sit and do everything manually. And this is why I provide automated tools. In order to calculate a position size manually, you need to, of course, have the overall account balance, which may be $10,000. Then work out your percentage risk per trade, which is maybe 1% or 2% based on the trading position. You may see a higher quality setup, therefore you risk 2%. You need to know what the stop loss is in pips, or where you're going to place your stop loss. Now this applies directly to currency pairs. This is for Forex and commodities. Mainly applying to Forex, we're working out the stop loss in pips here. Let's say you had a stop loss of 100 pips. You then need to identify the currency pair you're trading, which may be Great Britain pound, US dollar. Then you need to work out the value per pip based on the currency pair, because of course the value of the pip is going to change depending on which currency pair you're trading. And then this is how you calculate the unit or lot size required. And this aligns with your overall account balance. And this is how you risk 1 to 2%. So for most people, they don't have the time to do all of this. They don't have time to do it manually. And this is why we have calculators to do so. So now we could do it manually, as mentioned. It would be very, very time consuming. Every unit and lot size value is different depending on the currency pair you're trading. So you're not always going to be trading half a lot or one lot. It will change depending on the currency pair you're trading and the risk per trade and the stop loss. I personally use a position size calculator for this process. I don't do it manually. If I can save even 2 minutes per day every single day, I'll change it. If I'm doing something manually and I can save myself time, I will make the change. And this is why I use all of these automated tools, because it makes your trading process that much quicker. Now, these can be found on various Forex websites, the calculators I've been talking about, or frequently available through your broker. Now, you could place a trade through your broker, and a 1% or 2% trade could be worked out automatically. So when you put in the stop loss level and the take profit level, let's say your account value is $10,000, your broker may tell you the value of the stop loss and take profit automatically. So you could be looking at your stop loss, and the broker may tell you your stop loss is worth $100. Therefore, you know it's 1%. Now, if your broker doesn't offer this, we do have calculators that we use on MyFXBook. And this leads on to our next topic for today, which is trading tools. Now, using calculators, as I've mentioned multiple times now, will save you a ton of time rather than doing everything manually. And the below tools will be extremely valuable throughout your entire trading career. So as mentioned, if your broker doesn't offer these kind of calculators, we do have other calculators we can use. The first one is a pip calculator. The second one is a position size calculator. And the third one is a margin calculator. And all of the links for these calculators are below today's module. What I'm going to do is jump onto my web browser. We'll go through all three of these calculators, break them down so you can understand how to use them when you're trading. Here we are on MyFXBook. If you click the links below today's video, it will take you to the exact site that I'm on just now. We're now looking at the pip calculator. This calculates the value of an individual pip. Now let's say, for example, you're trading 100,000 units, which we know is one trading lot. When you click calculate, it will tell you the value of that pip down this side here. So we can see here pip value. It will tell you the value for a standard lot, which is one trading lot, 100,000 units, 10,000 units, which is a mini lot, and then 1,000 units for a micro lot. Now we can also change the account currency. So for myself personally, it would be Great Britain pound. We can see it adjusts that for us. So you would select your currency here, which will typically be Great Britain pound or US dollar. Now it may be Australian dollar or Canadian dollar, possibly euro, but for the most part it'll be US dollar. So you select your account currency in which you're trading, the lot size or trade size, the unit size you're going to use for that trade. Now this can just be used to, if you're calculating your position size manually, you can use this pip calculator just to calculate the value per pip based on the currency pair you're trading. Now this calculator, I don't typically use it because the position size calculator is that much easier, but I just thought I would provide this because there are people who want to calculate their position sizes manually. So this is a handy tool to use. And we can see here, if we're trading Australian dollar, Canadian dollar, one standard lot, which we know is $10 or £10, is actually $7.09. Now if we look at Australian dollar, Swiss franc, it's $10.63. We then look at Australian dollar, Hong Kong dollar, it's $1.27. So you can see it does change significantly depending on what you're trading. And this is why it's important to use these kind of calculators instead of doing it all manually. Now the next calculator is a position size calculator. This is the one I would use personally. I've not used it in a while just simply because my broker offers these calculators built in on the website. Now I will use this if that's not available. What we do is enter our account size. Let's assume it's $10,000. We are risking 1%. So we have risk ratio and percentage, which is 1%. The stop loss in pips. So whatever you're trading, if it's, let's say, Euro US dollar, which we have here, let's say it's 200 pips for the stop loss, which is relatively easy to work out. Let's say we're trading a bullish bat, the stop loss is at 1.13. All we do is look at where our entry point is and our stop loss, and what is the distance in between that area. So we look at our entry point and the 1.13 level for the bat pattern, which is the stop loss. We look at the distance in between that area, and that is how we work out how many pips it is. So this may be 200 pips. We're maybe trading a 4-hour chart. Our account currency is in US dollars. Again, it will typically be pounds or dollars for most students. And then all we do is click calculate. And we can see here the 1% risk would be $100, which is correct because we're trading a $10,000 account. The units we would be using is 5,000 units. So it's not 0.1, it's 0.05. So a small trading position we're using here. Now if we change the pips to 100, we can see that now the lot size changes. We can see that it's now 0.1. Now if the pips was 50, for example, we can see it's now 0.2, so you're now trading 20,000 units. Now let's say for instance you're trading gold. So we do have commodities on here as well, which is extremely useful because many people don't know how to work out pips for when we're trading commodities. So this is why this position size calculator is extremely useful. Let's just say it was 200 for example. We would then be trading 0.05. Let's say we're trading Great Britain pound US dollar. 200 pips again, 0.05. For 100 pips, we're looking at 0.1. Now you can use this in combination with the previous calculator, so you can work out the exact value of the pip of that currency pair you're trading. This should typically do it manually. It should calculate the value per pip based on the currency pair you're trading. It may fluctuate slightly, so you can compare it. You can work out the value of your trade size first on this calculator here, and then look at the value per pip. Now the final calculator is something called a margin calculator. This isn't something I'm going to explain today because it is included in day 14. We go over different parts of a trading account. We go over margin, which is one area. We also go over leverage. So this won't make any sense at the moment, but just keep it favorited on your browser. Favorite this margin calculator, also favorite the position size calculator and the pip calculator. Now, if you're using someone like Oanda for your broker, when you're on their trading platform, they calculate the value of the pip automatically. They calculate the value of the stop loss and take profit. So these calculators, you may never use them, but just in the worst case scenario that your broker doesn't offer this, you do have these calculators to fall back on. I feel like that's it. That was just a brief overview on how to use these. Let's head back to finish off the rest of day 12 part 2. Alright, let's just wrap it up for today. It's been another successful module from day 12 part 1 all the way to part 2. We've covered a lot of useful information, and we now know that we need to use a stop loss and we need to use a take profit level when trading. The bat pattern stop loss is 1.13. The Gartley is above or below X. The butterfly is 1.414, either just above or just below that level. And the crab pattern is 2.0, a solid 2.0 stop loss. Always use a stop loss and take profit. I'm going to keep saying this until you guys do it. It's all about repetition. If I don't keep telling you, you'll forget. So I want you guys to remember, use a stop loss and take profit when trading. Know when you're getting out before you get in. And I promise that's the last time I'm going to say that. So not only does it protect your capital, but it makes your trading easier for you to manage. Let's say you have a day job, which most of you will have. You don't want to be getting up at 8 in the morning, you place your trade, you go to work, then you worry about your trade. You don't know which direction it's going in. You then check on your break. You're then going off to the toilet to check your trade. You're checking your trade while you're working, just so you can manage it. Whereas if you had a stop loss and take profit in place, you know that you're not going to lose more than 1%, or you're not going to lose more than 2% of your account because your stop loss is in place. And if price increases and goes in the way that you dictate, then it's going to be closed in a 2 or 4% profit. So you don't need to manage it whatsoever. And you know that if you're a swing trader, your position may take 5 days to hit your final take profit level, or 10 days to hit your final take profit level. So there's no need for you to be checking it every single day while you're working. You can confidently go off to work, come back, and then check your trading position. See how it's developing. Is there anything you can do? Can you manage the position? Has it hit your first take profit level at 0.382? If it has, have you moved your stop loss into profit yet? Have you moved it to break even? If not, then you manage your trade. And it just makes the whole process very easy to manage. It's not as stressful, and that's why many people get stressed out. They're not using a stop loss, they're over risking. They don't have a clearly defined vision for the charts. They don't know where they're getting out. They don't know exactly where they're getting in. Whereas we do have that. We have a very solid trading strategy. We know exactly where we're getting in. We know once price passes this certain point, it's considered a losing trade. Once price hits this point, we take our profit and we walk away from the market. And it's really just that simple. Now in our next module, which is day 13, Trading Psychology, probably the most important module of the 14-day course, we will be covering the influence of fear and greed, followed by the 14 stages of investor emotions, then plan your trade, trade your plan, and finally, incomparable comparison. So a very exciting module indeed. I cannot wait to go over this one. I want to thank you guys for joining me on today's module, and I'll see you on the next video.